The Daily Telegraph is reporting that landlords are now cashing in on soaring house prices, forcing renters into bidding wars, and this is sensational journalism at its best. Apparently the rental supply has plunged by 50% as investors have quit the market. Good afternoon, welcome to the Market Wrap for APW, week ending 22nd of April 2022. This is number 97, Stuart Williamson here at the helm. I never thought I'd get to 97, quite amazing. Why do we do this? Information, common sense, helps people decide where, how and if to buy UK property, okay? Just as simple as that. Please do comment if you get a chance, do like, subscribe, all that sort of stuff, as it'll help guide direction of good information for future wraps. Now last week we had a comment from a gent, I think, saying, do we make money from selling property? Well, the answer is yes. You know, that's what we are, we're a buyer's agent. But it's not a sale at all costs approach. And I want to give you shares with you some of this week's experiences. I cancelled one client in China to not buy because there's too much doubt in their future. They have to get their future sorted before they can start making buying decisions. A client in South Africa, I said, why not go to the UK and rent first and see where suits before jumping in? You know, he's from Monmouth, and Monmouth's changed a lot in the last 20 years. Then a client in Switzerland said, I'll wait and see if the market's going to crash. I said, it's time in the market, not timing the market. So there we go. Now this is what we're covering. Nightframe Report, what is the UK market doing? Most importantly, what is the cost of living bite? What is that doing to house prices? And are they going to slow, and are rents going to go up? Basically, we believe they're going to, frankly, go up by 20% over the next 5 years, which is very important for buy-to-let investors, because that's what rents do. Rents are the most important thing when it comes to buying property. You've got to get a good, consistent income from a property that grows. So even if your mortgage goes up, it doesn't matter. Now, Knight Frank say that the market has defied gravity since the pandemic. Low interest rates, plus housing wealth, plus more goal for more space and greenery has conspired to create double-digit house price growth in the last year. Knight Frank believe that 2022 is when it will start to unwind and growth will return to single digits. They forecast that house prices will grow by 5% this year, with a number of factors being a drag on the rampant growth. Okay. What is the drags that are going to occur? Mortgage rates will continue to rise alongside interest rates. We know that. Okay, the UK conflict may slow the pace of normalisation post-COVID, but the Bank of England will feel the need to respond to inflationary pressures in the short term, and they will need to put up interest rates. But at the same time, they need to be concerned about the UK's long-term economic recovery. So perhaps not as quick as they would. And crucially, they believe that there will continue to be increased distortive effect from the pandemic, but these will fade. The supply shortage, which has been the biggest cause of strong house price growth over the last 2 years, there are early signs that this is now abating and the spring stock is coming back. Meanwhile, the race for space will calm down without disappearing altogether. For many people, the post-COVID work-life balance is far from set in stone, and demand will be fueled by a desire to improve living arrangements after successive lockdowns. And that's a fact. I'm still talking to people now who are calling it a day in Singapore and heading back to the UK, leaving Hong Kong because of COVID there, fed up with China because of what the situation is there. But the accumulated household wealth and the fact that many sectors of the economy have performed well has created a huge amount of cash, and that has led to a lot of purchasing. However, Knight Frank believe that the cost of living squeeze will start to bite in 2023, and that will have an effect on the market. This is a graph to help you visualize that. Knight Frank expect house prices to decline by 1% in 2023 before starting to slowly pick up again after that. In the 5 years to 2026, they believe across the UK it'll give a cumulative growth of 13.6%. Now some regions will outperform that as they benefit from the UK's changing economic economy after COVID. The Midlands, for example, they believe will benefit from growth of logistics, e-commerce and life sciences. Moving on to London, in prime central London, where it's £1.1 million plus houses, they forecast a 3.5% growth this year as the property market inside Zone 1 continues its overdue recovery after 6 years of political uncertainty and an emergence from a very negative tax landscape. The forecast that growth will be 6% in 2023. That's because the international buyers have been coming back in. It's been delayed because of the COVID situation. They believe the process will be quite gradual and fairly erratic, because many countries deal with opening the borders differently from the UK. Nightframe forecasts 22.2% growth in prime central London over the next 5-year period. In an echo of the wider UK market, they expect prime outer London to continue to benefit from the race for space during 2022, but this will tail off in 2023, producing 15.9% growth over the 5-year period. It's a similar story in prime country markets, where they expect growth to be 17% over the next 5 years. Prices in prime markets outside of London are supported by the fact there's much more headroom for growth compared to London, because London was so expensive. Only exception to that would probably be Cambridge, which on the back of AstraZeneca has gone through the roof. And here's another graphic to help you understand that. Now, this is really the important bit. UK rental market forecasts. UK rents are forecast to increase by 4% in 2023, building on a strong performance from last year. And longer term, they say, supply constraints, strong tenant demand, and robust earnings growth will support an increase of 17.1% in rental values over the next 5 years on average. At a national level, they believe the rental market is being shaped by a deepening supply and demand imbalance. Okay, so this is not new property coming in, people being short of buying it. This is just a shortage of rental properties. The number of properties available to rent during Q1 2022 was more than a third lower than the 5-year average pre-pandemic. At the same time, demand from tenants has continued to rise. The Royal Institute of Chartered Surveyors residential survey reported that tenant demand rose to its highest level since 1999 in January, while new landlord instructions remained in decline. In part, the supply shortfall reflects the fact that some landlords have just quit the sector because of the tax and regulatory changes. And it's a trend that Nightframe are saying this will not be reversed. So there's going to be less landlords out there because it's not as tax efficient if you're a UK tax resident to do it. They forecast a shortage of rental homes relative to demand will be a key factor underpinning rental growth in all regions, notwithstanding the fact that short-term inflationary pressures will inevitably act as a brake on larger rises in household finances, as household finances are stretched. Current forecasts from Oxford Economics suggest inflation will end 2022 at 7%, though cumulative inflation is only expected to increase by 13.7% over that 5-year period. Nightframe also see in the latter part of that 5-year period, forecasts for earnings growth will be a main driver behind rents, so earnings growth, income growth, resuming a long-term relationship and supported by a robust outlook for the employment market. So good earnings growth, good salary increases. There's a scope for stronger rental growth in areas of the country where rents are more affordable. Again, important point, particularly in the North and the Midlands. Okay, the prospect of further regulatory reforms towards the end of the forecast period, largely around EPC certification, will have a dampening on supply again, which could further push up the limited supply of rental. So again, have a look at this graphic. So basically, you've got less and less landlords out there. You wouldn't become a landlord in the UK because it's not as tax efficient as it used to be. So therefore, why do it? There may be other things you can do that are more tax efficient. What about London? The rental market in London and home counties is the same. High demand, low supply. And they forecast that it'll produce growth in rentals of 8% in prime central London this year, and very strong annual growth in the early months of 2022 as a flood of short-term property that was occupying the longer-term space is eroded from the market. Supply has subsequently dried up during this period because people were just doing short-term lets and not long-term, and the regulation around that was very relaxed. But now, as offices and universities are reopening, that lack of long-term accommodation is being shown up, and consequently rents are increasing very strongly in that sector. Nightframe believe that the rental growth will normalise from next year, and they expect increases of below 4% in prime central London from 2023, producing an cumulative rental growth, check this out, 22.7%. That's huge. But think about it, the last 2 years hasn't gone up at all. We expect less of a marked imbalance in prime outer London. For a growth of 5% this year, they expect it to be in like the UK average, between 15 and 20%. Now, the Daily Telegraph is reporting that landlords are now cashing in on soaring house prices, forcing renters into bidding wars, and this is sensational journalism at its best. Apparently, the rental supply has plunged by 50% as investors have quit the market. 50% fall in the number of flats or houses out there to rent. Sounds a little bit skewed. It says buy-to-let landlords are cashing in on rocketing house prices and selling their properties, causing a slump in the supply of rental homes. It means that competition for these rental properties is at an all-time high, and some landlords are forcing people into bidding wars to get into properties. Okay, rents have risen, according to Telegraph and Rightmove, by 11% year on year across the UK. Now, I don't know about this bidding war stuff. That sounds a bit fantastical to me. But surely, apparently, there are too many tenants trying to get in and not enough houses out there. In London, outside London, it's now £1,088 average rent per month, which is the first time rents have exceeded a 10% growth in a year ever, and they're now 15% higher than they were pre-pandemic. Rents in London are now £2,193 per month, which is 14.3% jump compared to last year, and it's the biggest jump in anywhere in any region since Rightmove's records began. Why is there such a shortage now? As we say, landlords are capitalising on high prices and selling, and then secondly, it's not as tax efficient in the UK as it used to be if you are there, because you don't get the likes of the Mirus tax reliefs that you used to get, mortgage interest relief at source. And as we covered, I think 2 weeks ago, you see a much smaller profit if you're a landlord in the UK. Here's a graphic on rents increasing. That's quite interesting, I think. Okay, so consequently, the number of properties apparently has fallen by 50%. Tenant demand has climbed by 6%, which now means there are 3 times the number of tenant applications for each available rental property. Now, what does this mean to us as buy-to-let investors internationally? We've got these SPV, single purpose vehicle approach, very tax efficient. We've got our own UK tax allowances, which are not, if not used, are very tax efficient. And in many cases, we've got a better disposable income than most people who are working in the UK. That allows us to better deal with inflation and price rises. Therefore, from our offshore perspective, a shrinking buy-to-let market is a buying opportunity. It's fantastic if you have the cash. Get a good mortgage make sure you've got enough buffer in there to cover it if interest rates do go up. Now, I'm not being unsympathetic to UK investors, because the worst hit in the UK are those who have no money. And I can talk personally, because my sister-in-law has a 24 and a 28-year-old, and they've had to move back home because they could not save any money while they were renting and working elsewhere. So it is very difficult. The cost of living has gone up terribly, and I'm not denigrating that or saying it's anything cheap or anything like that. But the point is, we are in a good position as international investors to buy property in a shrinking market. JP Morgan once said about stocks and shares. He was asked, how does he make money? And he said, I buy when everyone else is selling, and I sell when everyone else is buying. What does that tell you now about the UK property market? That's it for this week. Thank you very much. Do take care. Like if you like it. Comment if you can, it'd be lovely. And press the little alarm button to remind you when the next one's out. Thanks very much. Cheerio. Bye-bye.